So with all this data and the S&P 500 within striking distance of an all-time high, I do want to bring in Thomas Hayes. He's a chair and managing member at Great Hill Capital. Thomas, welcome.
Thanks for having me, Kristen.
Great to have you on the show. I think last time you were here, we'd seen a lot of volatility in the markets. You were bullish. Are you bullish today?
We continue to be bullish. We have some tailwinds here, Kristen. First off, the ceasefire. I mean, Iran's nuclear ambitions were completely decimated over the weekend. Boeing bunker bombs absolutely decimated the sites. Then you've got the big, beautiful tax bill. President Trump says, no vacations until we get it done. That's going to be very, very constructive in terms of tax cuts. And then we can get on with growth and deregulation. We went from tariffs and wars to growth and deregulation. That's a very positive thing. And then finally, the natives are getting restless. You've seen 3 dissenters come out against Chair Powell, with Bowman, with Goolsbee, and with Waller. And I think you're going to see more to follow. And I think the reason is very simple. You and I are paying an extra $600 billion a year in interest payments, which is entirely unnecessary with inflation where it is, and 72 million millennials who are desperately trying to start their lives and family formation can't afford a home, largely because of one man focused on his legacy, worried about becoming Arthur Burns, and the conditions of the economy and the population are nothing like the period that Arthur Burns was in power as Fed chair. So these are the 3 key tailwinds.
And you're referencing there Jerome Powell, obviously, the head of the Federal Reserve, driving the path forward for interest rates. He has said multiple times, Thomas, that he wants to take this wait-and-see approach, that he does anticipate that inflation will rise due to tariffs. So what is your response to that if, in fact, inflation does rise in the months ahead?
Look, it's very easy. Look, the Fed mandate, they're supposed to be data dependent. He is now prediction dependent. Jay Powell is so certain that inflation is going to rise. But if you look at his summary of economic projections, he acknowledges it's a temporary bump. It's like a one-time tax. Also, if you look at his predictions, he's showing real GDP at 1.4%. If he believes in his own predictions, he should have cut 50 basis points in June. So you can't have it both ways. I think this is one of the first times in history we're seeing the Fed being prediction dependent versus data dependent. And that's a risk. And I think the pressure is on because, if you look at the average age of a person buying their starter home, it's been pushed back, 5 some odd years because he got transitory wrong and he got autopilot wrong. So it's time to get it right. And this is a chance to preserve his legacy. And you know what? If he is right, he can always hike 25 basis points. It's much easier to quell inflation than it is to deal with deflation and unemployment. That's very, very costly.
Yeah, September 2022, that infamous transitory word, right?
Yes.
The one that you referenced there that many of us do remember when it comes to the path forward for Fed policy. So you're bullish, you see tailwinds. Thomas, what do you like in this market?
Yeah, I think you've got to be nimble here because we're going to push to new highs this summer, no question about it. But if you just buy the indices, I think you're going to be a little disappointed. You got to look under the surface for the things that haven't moved yet. If you look at earnings growth, so the Magnificent 493 first quarter, the Magnificent 7 first quarter, 27% earnings growth. That will decelerate by first quarter of next year to 10.2%. The unmagnificent 493, the rest of the market, went from negative earnings growth last year. It's going to be 10.3% by first quarter of next year. So basically what you have is 493 stocks earnings going up, multiple is much lower, and the 7 earnings growth basically collapsing and the multiple is still high. So you want to look under the surface of the 493. I got one for you that you're going to love.
Yes.
Estee Lauder.
I know Estee Lauder well.
Okay.
And we've seen them down here on the floor of the stock exchange quite a bit.
Yeah, they completely screwed things up. Okay, but Turnaround Tom loves turnaround stories. Great businesses when they're marked down. Part of what hurt them was, in fairness, 2021 to 2024, the COVID policy in China was pretty rough. They have 30% of their revenues out of China. As bad as that was, and the stock's down 2/3 because of that, they did maintain 99% of their share in China. So as China is now starting to recover, they're going to get that tailwind. They're number 1 in the premium brand category in skincare and in cosmetics across the world. And they have more than one brand. Sometimes I say Estee Lauder and people go, oh, isn't that just mostly old ladies, blah, blah, blah. First off, it's phenomenal makeup.
They do well with my clientele, I'll tell you that.
Okay. Well, you're too young for it. All right. Estee Lauder. They've got MAC. They've got Dr. Jart for the young kids, the Korean stuff. They've got Clinique. They've been buying and selling brands for over a century, and they're going to continue to do the same. They're going to pivot. They've got a margin reacceleration plan. They've got a new CEO in place. Deutsche Bank upgraded on Monday to $90. Stocks are 70, 75 right now. This can be a double over the next 3 to 5 years. We love high quality businesses. It's compounded capital at double digits for decades. It's going to continue to do so. Everyone wants to look and feel good, right?
Yeah. Right. We will be watching Estee Lauder indeed. Anything else, Tom?
Yeah, I've got a hairy one that no one's going to want, which I always have to bring you one that makes people a little bit uneasy. Advance Auto Parts, okay? They got it completely wrong. O'Reilly's eating their lunch, and they brought in a new CEO named Shane O'Kelly. He's been turning the business around. He came from HD Supply, $7 billion business at Home Depot. He sold off Canada, paid down some debt, closed 500 unprofitable stores, cleaned up. Now he's starting to re-expand. He's opening 100 new stores in those areas where he's number 1 and 2 in the market, which is 75% of the stores now, consolidating distribution centers to get the parts to the professionals quickly. Margins are going to expand from 2% to 7.5% over the next couple of years. Last time margins were that high, the stock traded about $150. It's only $50 right now. So we think that could be a double to a triple over the next 3 to 4 years.
So I do want to ask holistically, obviously it sounds like the Fed could be a risk to the downside if they are late on lowering rates, Thomas, but in terms of where we go from here, if you are bullish, what is your target for the S&P 500?
Yeah, that's a good question. In terms of the S&P 500, I don't spend a lot of time with that because I'm not correlated as much to the S&P 500. I look at discrete businesses. But I think we can, history says when you have this type of V-shaped recovery, 12 months out, after you rise 20%, as we have in the last couple months, the market's up on average another 20%. So I think 7,000 in sometime in 2026 is a realistic expectation. Probably towards the end of the year, this year, maybe 6,500, 6,600 would be a reasonable expectation. But new highs, and then we get into some fall volatility, and then probably year-end rally.
All right. We'd like to see a lot of green on the screen down here on the floor at the stock exchange. Thomas Hayes, he's a chair and managing member at Great Hill Capital. Thomas, thank you.
Thank you for having me.